For decades, retirement planning followed a predictable formula in which financial advisors encouraged middle-class workers, corporate professionals, pension holders, and long-term savers to trust diversified portfolios built around stocks, bonds, mutual funds, and confidence in central banking stability. And that strategy appeared effective during periods when inflation remained moderate, supply chains operated efficiently, energy prices stayed manageable, and confidence in fiat currencies remained relatively strong. But the global financial landscape entering this decade is fundamentally different because sovereign debt levels have exploded beyond historical norms. Governments continue issuing trillions in new obligations, while central banks quietly struggle to maintain monetary credibility. Before this financial shift accelerates further, viewers should subscribe to the channel, like the video, and share their thoughts in the comments section so they never miss future market alerts, wealth preservation strategies, and critical retirement updates that could become extremely important in the coming months. Inflation continues eroding purchasing power across housing, healthcare, transportation, food, insurance, and energy sectors. Despite official narratives suggesting moderation, and retirees are becoming increasingly vulnerable because fixed income streams no longer keep pace with the real cost of living, while bond markets that were once promoted as safe havens have experienced historic losses due to rising interest rates, exposing how fragile traditional 60-40 retirement portfolios became after years of artificially suppressed yields. And the simultaneous weakness across equities and fixed income assets has forced institutional investors to reconsider the foundations of wealth preservation entirely, especially as consumer debt rises. Banking systems carry hidden vulnerabilities, corporate defaults begin increasing in stressed sectors, and geopolitical instability threatens to disrupt already fragile global supply chains, creating an environment in which retirement savers can no longer assume the systems protecting their wealth today will function reliably tomorrow. This growing uncertainty is precisely why institutional capital has increasingly started repositioning toward tangible hard assets, particularly precious metals, because unlike speculative financial instruments dependent on confidence and liquidity injections from central banks, silver represents a physical asset with intrinsic value, global recognition, and dual functionality as both a monetary metal and a critical industrial resource. And this combination gives silver a uniquely strategic role in the modern economy, since it supports renewable energy systems, electric vehicles, advanced electronics, artificial intelligence, hardware, military technologies, telecommunications, infrastructure, semiconductor manufacturing, and medical equipment through its unmatched electrical conductivity and industrial efficiency, while at the same time retaining thousands of years of historical credibility as a store of wealth during periods of monetary instability. And what makes the current situation especially significant is that industrial demand for silver is accelerating rapidly because governments worldwide continue subsidizing green energy transitions and electrification projects even during economic slowdowns. Yet mining output is struggling to keep pace due to declining ore grades, rising extraction costs, political instability in major producing regions, environmental regulations, and a lack of significant new discoveries, creating a widening imbalance between future demand expectations and available supply that many commodity analysts believe could eventually trigger one of the most important supply squeezes in modern precious metals history. Historically, periods of financial uncertainty combined with rising industrial demand have often created explosive moves in precious metals markets. But silver behaves differently from gold, because gold usually responds first as a defensive monetary asset, while silver frequently accelerates later with substantially larger percentage gains due to its smaller market size and industrial exposure, which is why experienced investors carefully monitor the gold-to-silver ratio during times of monetary stress, since historically stretched ratios have often indicated silver was undervalued relative to gold. And many analysts today believe current pricing remains disconnected from underlying fundamentals, because the broader market still underestimates how rapidly conditions could change if investment demand begins increasing alongside already elevated industrial consumption, especially considering that the physical silver market is relatively small compared with the scale of institutional capital capable of entering it during a major flight towards safe haven assets. And this concern becomes even more important as nations around the world gradually reduce dependence on the United States dollar through alternative trade agreements and reserve diversification strategies, because this slow-moving de-dollarization process reflects declining confidence in long-term fiat currency stability, while central banks themselves continue accumulating precious metals reserves as protection against future monetary disruptions, demonstrating through their actions that concerns about systemic financial fragility are far more serious behind closed doors than public narratives often suggest. The deeper issue facing retirement savers, therefore, is not simply whether silver prices may rise dramatically in the future, but whether traditional retirement assumptions built during decades of monetary expansion can continue functioning effectively in an era defined by debt saturation, inflationary pressure, geopolitical fragmentation, and declining trust in financial institutions. Because history repeatedly demonstrates that major market transitions occur suddenly rather than gradually, with liquidity disappearing rapidly once panic begins, premiums surging across hard assets, and investors who delayed preparation often discovering they can no longer secure protection at favorable prices, particularly in silver markets, where physical inventories can tighten quickly once demand accelerates. And this is why experienced wealth preservation strategists increasingly argue that intelligent investors are not waiting for mainstream confirmation before adjusting their allocations, but are instead positioning themselves while markets still appear relatively calm, understanding that retirement security in the coming decade may depend less on maximizing speculative returns and more on preserving purchasing power against systemic instability through disciplined diversification into tangible assets with enduring real-world value. Because those ignoring the warning signs emerging across debt markets, banking systems, currency structures, and global supply chains may ultimately discover too late that the financial playbook which protected previous generations was designed for a world that no longer exists. The modern investment environment is entering a phase where traditional assumptions about financial safety are being challenged simultaneously across stocks, bonds, banking systems, and fiat currencies. Because retirees who once believed government bonds guaranteed stability, blue chip equities guaranteed long-term growth, and central banks guaranteed economic order are now witnessing rising debt burdens, persistent inflationary pressure, weakening consumer conditions, geopolitical fragmentation, and declining trust in institutions all occurring at the same time. And this combination is creating conditions remarkably similar to historical periods that triggered powerful migrations toward hard assets, particularly precious metals. While silver is emerging at the center of this transition because it possesses characteristics few other assets can match, since it is simultaneously monetary, industrial, strategic, and globally recognized, and unlike many speculative assets, dependent entirely on investor sentiment. Silver maintains real-world utility through renewable energy systems, electric vehicles, semiconductors, military electronics, medical technologies, telecommunications, infrastructure, artificial intelligence hardware, and advanced manufacturing sectors, all of which require substantial quantities of silver because of its unmatched conductivity and industrial efficiency, creating a situation where demand growth is accelerating rapidly while public awareness of silver's strategic importance still remains relatively limited. One of the strongest arguments supporting silver's long-term potential is the growing disconnect between physical supply realities and paper market pricing structures. Because enormous quantities of silver trading occur through futures contracts, derivative systems, and synthetic exposure rather than direct physical ownership, leading many analysts to argue that the market has operated for years under pricing mechanisms disconnected from the amount of immediately available metal, and whether one fully accepts manipulation theories or not, the structural vulnerability remains obvious because if investors increasingly demand physical delivery instead of paper settlement, inventories could tighten rapidly and create violent price movements due to the relatively small size of the global silver market compared with the scale of institutional capital capable of entering it during periods of financial panic, while industrial demand continues expanding through electric vehicle production, solar panel manufacturing, semiconductor development, defense modernization, and green energy infrastructure programs supported by governments worldwide. Yet mining conditions continue deteriorating because major producing regions face political instability, environmental restrictions, declining ore grades, rising extraction costs, and limited new discoveries, creating a dangerous mismatch between future consumption expectations and realistic production capacity that many commodity strategists believe could eventually trigger one of the most important precious metal supply squeezes of the modern era. At the same time, central banks around the world are facing an increasingly impossible balancing act because maintaining elevated interest rates for too long threatens economic growth, banking stability, employment conditions, and government debt sustainability, while aggressively returning to monetary easing risks, reigniting inflation, and accelerating currency debasement. And this policy trap is deeply concerning for retirement savers because inflation silently destroys purchasing power even when nominal investment balances appear stable, which is why sophisticated wealth preservation strategies are increasingly incorporating tangible assets outside traditional financial systems, particularly silver because it remains more affordable and psychologically accessible than gold for many retail investors, allowing ordinary savers to accumulate meaningful physical positions more easily during periods of economic uncertainty, and historical precedent strongly supports the possibility of major silver outperformance during monetary stress. because previous precious metals bull markets repeatedly demonstrated that silver often produces larger percentage gains than gold. Once momentum intensifies, especially during environments characterized by inflation fears, aggressive money printing, declining confidence in financial institutions, and systemic instability similar to the conditions now emerging globally. Importantly, experienced analysts are not arguing that retirees should abandon every traditional investment and move entirely into silver, because that would represent speculation rather than disciplined wealth preservation. But they are increasingly emphasizing that portfolios heavily concentrated in paper assets may lack sufficient protection against systemic shocks, inflationary crises, banking disruptions, currency devaluation, and broader market instability, which is why many institutional observers believe intelligent investors should begin preparing before mainstream narratives fully recognize the magnitude of the transition underway, since history repeatedly demonstrates that the best opportunities for strategic positioning exist before fear becomes widespread. And once the public rushes into safe haven assets, physical inventories tighten rapidly, premiums surge, and emotional decision-making replaces disciplined planning, making calm preparation far more difficult. Therefore, the growing institutional interest in silver reflects a broader recognition that the global economy is entering a structurally uncertain era defined by debt saturation, monetary instability, industrial transformation, and geopolitical fragmentation, and retirees who fail to adapt to these evolving realities may ultimately discover that the greatest financial risk was assuming yesterday's retirement playbook would continue functioning indefinitely in a world that is changing faster than most people realize. The most important principle in retirement protection is not maximizing speculative returns, but preserving purchasing power during periods of systemic instability. And today's global economy increasingly resembles the early stages of a structural transition rather than a temporary market cycle, because debt saturation, inflationary pressure, banking fragility, geopolitical fragmentation, weakening consumer conditions, and resource competition are converging simultaneously across the global financial system, creating an environment that many experienced analysts consider historically dangerous for retirement savers heavily dependent on traditional paper assets, while governments continue expanding deficits despite slowing economic growth, and central banks remain trapped between maintaining restrictive monetary policy to control inflation or returning to aggressive easing measures that risk accelerating currency debasement even further. And this policy dilemma is particularly concerning because both outcomes create long-term threats for retirees through either recessionary market weakness or persistent inflation that silently destroys purchasing power over time, forcing sophisticated investors to shift their focus away from pure growth strategies and toward resilience, diversification, and tangible wealth preservation capable of surviving multiple forms of financial stress simultaneously. This is one of the primary reasons silver is increasingly being viewed not merely as a commodity, but as a strategic asset directly connected to the future architecture of the global economy, because it supports renewable energy systems, military technologies, telecommunications, infrastructure, artificial intelligence hardware, semiconductor manufacturing, advanced electronics, and medical equipment, while also maintaining historical credibility as a monetary metal during periods of economic uncertainty. And this dual role makes silver uniquely powerful, since weakening economic conditions may increase safe haven investment demand. At the same time, industrial expansion continues driving manufacturing consumption higher, creating a rare scenario where both monetary and industrial forces could support long-term price appreciation simultaneously, especially as institutional analysts increasingly recognize how limited global physical silver supplies may actually be relative to future demand expectations. Because despite growing industrial dependence, the broader public still largely underestimates silver's strategic importance, while mining production faces declining grades, rising extraction costs, environmental restrictions, political instability, and a lack of major new discoveries, creating structural supply vulnerabilities that could become extremely significant once broader investment demand accelerates. For retirees, the deeper issue is that traditional diversification assumptions may no longer provide sufficient protection because modern inflationary environments can damage stocks and bonds simultaneously, especially when financial markets remain historically overvalued and heavily dependent on continued central bank intervention, which is why experienced wealth preservation strategists increasingly recommend that investors examine their portfolios through a different lens by asking not only how much growth potential exists, but also how much systemic vulnerability exists regarding currency debasement, banking instability, liquidity crises, and broader market shocks. And in this context, silver is gaining attention because physical ownership removes counterparty risk, unlike complex financial instruments dependent on institutional solvency, while history repeatedly demonstrates that crises expose weaknesses investors ignored during stable periods, causing panic-driven migrations into safe haven assets that rapidly tighten inventories and increase premiums. Once fear becomes widespread, meaning investors who prepare calmly before disruption occurs are often positioned far more effectively than those reacting emotionally after the crisis has already begun. The phrase, "do this before Friday," therefore reflects a broader warning for market observers who believe the current financial environment may be far more fragile beneath the surface than mainstream narratives suggest, because liquidity conditions are tightening globally, consumer stress is spreading, commercial real estate markets are weakening, corporate defaults are rising in vulnerable sectors, and geopolitical tensions continue reshaping trade relationships and supply chains at a pace not seen in generations. All while central banks possess increasingly limited flexibility to stabilize every emerging risk simultaneously. And this is why many sophisticated investors are gradually allocating portions of their portfolios toward hard assets like silver, not as reckless speculation, but as strategic insurance against systemic instability and long-term currency erosion, understanding that retirement security in the coming decade may depend less on optimistic assumptions and more on intelligent preparation before the broader public fully realizes how dramatically the financial landscape is changing. Because throughout history, the individuals who preserved wealth across generations were rarely the ones reacting emotionally after crises erupted, but instead were the ones who recognized warning signs early, diversified intelligently, protected purchasing power, and positioned themselves before the rules of the financial system changed completely. Part 3 has now been fully divided into exactly 4 large professional sentences, while maintaining the same high-level institutional finance tone and detailed retirement protection narrative.